Hi there, and welcome to our brand new video series where we take a look at the biggest events over the week ahead and give you some insight into how the financial markets might react. I'm joined by trader and educator Chris Tubby from Symax Fintech. Hi Chris, thanks for joining me on video.
Hi Michael, good to see you.
You too, mate, you too. PCE data came out earlier today. Can you tell us a bit about why it's important?
Yeah, sure. I mean, for the Fed, it's one of their key metrics for inflation. So, it has quite a lot of input into how they're going to go about their next rate decisions. So, of course, they've got a little bit of time on their hands at the moment. They're going to see some more sort of non-farm payroll next Friday as well. But, the key thing for them is that inflation is sort of, it's sticky. It's not going up anymore for the moment, but it's not dropping as they'd like it to. And of course, the problem they've got is that they've got this 2% target rate. It's quite a sort of a generalized rate for a lot of the central banks. But they're just going to struggle to get there. One of the biggest problems for me there is services, number one, because of the wage demands that are coming through because of inflation. And then the other part of it also is that food prices, if you look at it, to me, it just looks as though the food giants are really sort of pushing their profit margins further and further. To me, quite honestly, I think they're abusing the public and supermarkets as well.
That's interesting. So how do you see the interest rates going for the Fed later in the month?
I think probably there's one, possibly two more quarters in there, quarter hikes, that is. They might get to about 5.25 overall, roughly. Again, they're taking it meeting by meeting at the moment, data by data. So it's they're trying not to sort of proposition the investors and the traders too much with this is what we're going to do and give that sort of forward insight, that forward guidance, because they've sort of come unstuck with that in the past, especially Powell last year, because he couldn't put rates up when he really wanted to, going back to the end of 2021. He had to start later, probably by about 6 months than he should have done.
So obviously that's going to be the big event of April for the markets as a whole. Obviously next week we've got central bank rate decisions coming up for Australia, New Zealand, and India as a precursor. I mean, how do you see those going?
I think Australia and New Zealand probably going to just hold and just look at some of the data as it's coming through. They're seeing their inflation start to drop slowly. For India, they've probably got another raise, probably another 0.25% or something, just because they're still seeing higher inflation at the moment. And what we should remember now, and one of the reasons probably perhaps why we should focus a little bit more on India going forward is that they are going to become the most populated nation on the planet. They're sort of going to take that sort of title away from China.
That's interesting. So obviously the banking situation, the issues with the banks that we've had over the last couple of weeks. This will be the first set of rate decisions from those guys, those countries. So you don't see them sort of making any knee-jerk reactions to what's been going on.
No, I mean, it's been sort of much more isolated around the US and sort of obviously one or two potential ones in Europe as well. In the US, it started with the crypto bank, then it went on to SVB, and then sort of it sort of rolled from there. And then the problem became, it was never going to become systemic. It was too isolated. I mean, if you look at SVB, it was just poor management, poor risk management. They didn't even have a proper risk manager for it the last year.
That's it.
So they, in my mind, they got what they deserved there because, but I tell you an interesting point here is, and this isn't just that particular bank, it's probably a lot of banks, and certainly the Federal Reserve themselves, is they're all sitting on a lot of these long dated bonds that they bought when treasuries were running sort of around 2%. And obviously now, the Fed's been pushing the market against themselves by hiking the rates, but they need to control inflation. But the fact that they've been sort of pushing those rates up, on paper, or they're looking at sort of quite heavy losses. Now, if you run them to maturity, then it's not the end of the world, and you are getting some sort of income from them. The problem is if you're having to pay investors that are depositing money with you higher rates than what you've actually locked in by buying the treasuries in the first place. And that was sort of one of the problems that SVB got into that sort of started that sort of bank run. And I think the other thing with the bank run as well is that it's so easy now for people to transfer money, electronically. They just go on their phone or on the laptop, computer, whatever it is, and it's gone within seconds. The days of a bank run where everyone had to go and queue up outside the front door to physically take their money out, they're well gone. And to a degree, that has the potential to work against the banks. But I think that, it surprised me. SVB was the 16th largest bank in the US, and it was considered a mid-sized bank. So the regulations around that was much less than obviously the big guys like JP Morgan's. Now, I think that in itself was a mistake, but going forward now, we're coming to the point where that they're already talking about the fact that regulations aren't as strong now as they should be. It goes back to sort of when Trump was in power, he watered down and sort of diluted a lot of the regulations then. Obviously, over COVID, they had to be reduced as well to allow banks to lend more, so it reduced down the restrictions behind them. But, to me now, it just seems as though, not that they're going to go overboard, but there are more stringent regulations that need to be placed on some of these banks.
So do you see, obviously, over the last 2 weeks, we've had lots of fluctuations, lots of volatility in the markets as a result. Do you see that all settling down now as we go sort of into April?
Yeah, I mean, in Europe, we had Credit Suisse, obviously. UBS was sort of bullied into buying them. But they did a great job there, actually, because UBS has got all these guarantees that if suddenly some skeletons come out and there's some real heavy losses involved, then they're sort of pretty much underwritten by the central banks and possibly the governments. But I think the worst of the banking sector's over. I mean, Charles Schwab, they got downgraded, which is the next one. But, they're sort of managing, I think it's about 7 trillion. So, but again, social media, when you look at it, media itself, the fact that you can transfer money so easily, all these electronic things, to the point where it's sort of, you can sort of start a ball rolling, have that domino impact on the markets, even if you don't mean to.
It's interesting. I guess from the years that you've been in finance and in the industry, then this is something you've seen before, isn't it?
Yeah, I mean, you always get these things. I mean, one of the things I covered during one of my courses is the last 200 years of economic disasters, and they're all pretty much the same thing. The trigger can be different, but it all goes through the same process. And of course, when you're trading through them, to a degree, you know what to expect when the next crisis comes and then the next crisis after that. And I think part of the reason there is the fact that when it's left to the central banks more than the governments, they've only got a plan A. They don't have a plan B. So when it comes to anything, their only solution is quantitative easing. And for me, it's the easy option. It's not the best option.
Yeah, that's interesting. It's, I mean, we see the volatility. We kind of expect all of that with these crises, you say, jumping from one to the other. But I guess as concerns dissipate, I guess we're looking at sort of some interesting times maybe for some risk on assets. What do you think?
Yeah, no, absolutely. I mean, if you look at the Nasdaq, the Nasdaq actually this week has traded at its highest level for 2023 so far, and it's actually reversed because it's recovered over 20% now, so it's officially back into a bull trend. And if you look at it in comparison to the S&P and other indices, it's actually moved at a much more aggressive pace where it's sort of recovered. For the S&P itself, I want it to get up about another 200 points, because then it's going to get to a level that it got to last April, May, and again in the summer in August, which I just love the fact that it got there, because I was just buying put options there, because for me that's sort of it's a real key level. It's about 4,300 on the S&P.
I think that's something you wrote about for us a little while ago, wasn't it? So
yeah, indeed.
We'll pop a link to the article on the comments in the video for you as well. So that's great. Thank you, Chris. That's been really useful. I know you've got some more analysis that you'll do sort of more in depth over the course of the weekend. So what we'll do is we'll pop a link to that on the comments as well, so people can find out a little bit more about your insight looking ahead to next week. I guess we've got Easter as well, so it's going to quieten down. Do you think that's probably
yeah, but because you sort of get a lot of traders want to spend time with their family as well, especially now out of lockdowns. They've actually been in the office, so they're going to value that time even more. But again, you've got to be a little bit careful, because when there's less players in the market, they can become more volatile, because that people need to do business. Again, of course, what we've got to remember about today, it was the end of the month and also the end of Q1. So there was probably a little bit of rebalancing in there. But going forward, it's going to be an interesting Q2 for sure, because we've got to see if the central banks are willing to sort of hold back a little bit, or they're going to continue this aggressive stance. I understand that they need to sort of get inflation under control, because that's their biggest fear. And I think it's been a shock to them as well, that the pace that inflation has picked up. And they can't control that. And of course, in the early stages, they certainly couldn't control it, because it was all coming from the supply side. Yeah, well, all they're trying to do really is dampen demand down to sort of balance out with current supply, without obviously pushing the markets into or the economies into recession, which they could easily do. And that sort of brings me on to my last point there, is they're not really giving enough time for the rate hikes that they're doing to feed into the economy, so that they can see the impact that they're actually having. And I think that's why they might sort of go too far with the rate hikes. And then as the markets and the economy plays catch up, that's, where the danger of a recession is going to come. But, for me, it's not the fact that they're putting the rates up, which is right. And of course, most people think, oh, high rates, but these aren't high rates. These are just more normal rates than where they should be. But the fact is, they're going to leave them there for longer. I can't quite honestly see them putting rates down this year.
Okay, well, let's hope they get it right. And I guess we're going to be doing this on a weekly basis, aren't we? So
I look forward to it.
So we'll hold them to account as we go through the year. Chris, thanks for joining me, and thanks everyone for watching. Until next week.
Have a great weekend.